Every nation claims to rule itself. Every democracy swears that power flows from its people. Yet behind every president, parliament, and policy lies a quiet empire that no one ever voted for. An empire that doesn't need armies, borders, or flags. It rules through the one force every government, every business, and every citizen depends on: money. You can't see this empire on a map. It has no capital city, no anthem, no elections. Its generals sit behind polished mahogany tables, their battles fought in interest rate meetings and bond markets. Its conquests happen in silence, when currencies collapse, when mortgages soar, when nations borrow just to breathe. We call them central banks, and their power is absolute precisely because it feels invisible. When they whisper a single percentage point, entire economies rise or fall. When they print trillions, the world applauds a rescue. When they tighten liquidity, millions lose jobs and homes, and through it all, they remain untouchable, unelected custodians of money itself. This wasn't always true. For most of human history, money was physical: gold, silver, grain, something you could hold. Kings might debase it, merchants might counterfeit it, but it still obeyed limits set by nature. Then, in 1694, a small building on Threadneedle Street rewrote those limits forever. It was called the Bank of England, and it proved that you could create wealth not by mining it, but by promising it. That promise would evolve into the modern central banking system, a network that funds wars without raising taxes, manipulates prosperity without producing goods, and shapes global politics while appearing merely technical. Today, 20 men in a Basel conference room can move more capital than all the emperors of history combined. But power that hides behind complexity is still power. And if history has taught us anything, it's that every empire eventually overreaches. So before we can understand the crashes and the crises, the inflations and the rescues, we need to return to the moment when money itself was captured. When finance became government, government became finance. Because the story of central banks isn't just about economics. It's about control. Who has it, how they keep it, and why the rest of us rarely notice until it's too late. London, 1694, a city of merchants, wars, and debt. England was exhausted, drained by endless conflict with France, and crushed under a mountain of unpaid soldiers and empty treasuries. The crown was broke. The empire was ambitious, but bankrupt. So a group of merchants and financiers proposed an audacious idea, a financial invention so radical it would change the world forever. They told the government, "Let us lend you the money you don't have, and in return, give us the right to print the money everyone else must use." That proposal became the Bank of England. It began as a private corporation, not a public institution, not a government department, a private company of investors who issued banknotes as loans to the crown. These notes were paper promises, but they carried royal backing. For the first time in English history, the state's power and private credit fused into one. Every pound created was born as a debt, and every debt was owed to those who issued it. To the people of 17th century London, it seemed like a miracle. Suddenly, the kingdom that had been financially paralyzed could fund fleets, armies, and colonies, all without waiting for tax revenue. Paper became power. But beneath that miracle was a quiet transaction that would echo through every economy that followed. The right to create money was privatized. From that moment on, wealth was no longer limited by gold or silver. It was limited only by the willingness of governments to borrow and the confidence of citizens to believe in the paper they held. The Bank of England could lend 10 times more than it actually had in reserve because few people ever demanded all their money back at once. That principle, fractional reserve banking, became the cornerstone of the global financial system. It was ingenious. It was dangerous. It made liquidity infinite and insolvency invisible until panic struck. And panic always comes. When rumors spread that a bank might fail, depositors rushed to withdraw their money, only to discover that their wealth existed more in promises than in coins. The first bank runs began here, and the lesson that followed would be repeated by every central banker since. Control the panic, and you control the people. But the Bank of England's true genius wasn't financial engineering. It was political transformation. Before 1694, kings begged for loans. After 1694, governments institutionalized debt. Borrowing became normal, even patriotic. Parliament could raise funds at will, backed by an institution that guaranteed the state's solvency and the banker's profit. That alliance between government and finance birthed a new power structure. Not feudal, not democratic, but something altogether modern: the financial state. From that point onward, empires would not rise through conquest alone, but through credit. Colonies would be funded by bonds. Wars would be financed through paper. And the very concept of sovereignty, of who truly ruled a nation, began to blur. Because when your government owes its survival to those who lend it money, who really governs whom? It was here in the candlelit ledgers of the Bank of England that the foundations of every modern economy were laid. Money ceased to be an instrument of exchange and became a tool of management. a lever to control nations, industries, and individuals. The bank's founders couldn't have foreseen the global system their idea would create. But every central bank since, from the Federal Reserve to the European Central Bank, to the Bank of Japan and the People's Bank of China, is built on that same 17th century logic. Create credit, lend it to the state, charge interest, and ensure the machine never stops turning. Debt became not a symptom, but a design. And with every new loan, the financial state grew more powerful, more essential, and more entrenched. The world had just entered a new kind of empire, one without kings or crowns, an empire of promises. For more than a century, America resisted the idea of a central bank. The revolution had been fought, in part, against the very system that turned governments into debtors and citizens into collateral. When Thomas Jefferson warned that banking institutions are more dangerous to our liberties than standing armies, he wasn't being poetic. He was describing a blueprint he feared would enslave the republic through credit rather than conquest. And yet, by the dawn of the 20th century, the United States had become the very thing it once rebelled against. A global financial power desperate for order, stability, and control. The road to the Federal Reserve began, fittingly, with chaos. The panic of 1907 exposed the fragility of America's fragmented banking system. Depositors lined up outside failing banks, desperate to withdraw savings that no longer existed. Stock markets collapsed, trust evaporated, and the nation teetered on the edge of economic paralysis. It was in that panic that a handful of bankers realized something extraordinary. The power to calm fear is the ultimate power of all. Behind closed doors on a private island off the coast of Georgia called Jekyll Island, 6 men gathered in absolute secrecy. Senators, bankers, and the architects of a new financial order. They represented a quarter of the world's wealth. There were no reporters, no public records, and no democracy. Only a mission: to create a central banking system that would look public but act private. That plan became the Federal Reserve Act of 1913. Officially, the Federal Reserve was a government institution. In reality, it was a hybrid, a creature of Congress but owned by its member banks, directed by unelected governors, and insulated from direct political control. Its structure was a masterpiece of plausible deniability. The public would see stability. The insiders would hold the levers. For the first time in U.S. history, the power to create money was centralized. Not in Congress, not in the Treasury, but in the Fed. And from that moment on, the dollar was no longer a fixed measure of value. It became an instrument of policy. The founders of the Fed claimed it would prevent panics, but in truth, it institutionalized them. By controlling interest rates, the Fed could now expand or contract the economy at will. It could inflate bubbles and then rescue them when they burst. And every time it intervened, the financial elite, the same families, firms, and funds who helped design it, grew richer and more entrenched. The irony was profound. America, born in rebellion against the British financial system, had recreated it on an even grander scale. The same mechanism that once financed kings now financed corporations and congressmen alike. The state borrowed, the banks profited, and the citizens paid, through inflation, taxation, and the invisible loss of purchasing power. Through wars, depressions, and recoveries, the Fed's influence only deepened. During World War I, it financed the war effort by issuing massive government bonds, fueling both prosperity and inflation. During the Great Depression, it learned that contraction could devastate entire populations, a lesson that would shape every crisis thereafter. By World War II, the Fed's coordination with the Treasury effectively turned monetary policy into a weapon of victory and of dependence. And after 1944, when the Bretton Woods Agreement pegged the world's currencies to the US dollar and the dollar to gold, the Federal Reserve's reach extended far beyond America's borders. It became not just the central bank of a nation, but the de facto central bank of the world. Every global trade, every oil barrel, every loan denominated in dollars reinforced that power. The Fed could print what the world needed and charge interest for the privilege. And when in 1971, President Nixon severed the dollar's last link to gold, the illusion was complete. Money no longer had to represent anything real. It could be created from nothing, backed only by trust managed by the very institution that profited from controlling it. The United States had achieved something empires had dreamed of for centuries. It ruled not by force, but by currency. And the Federal Reserve was its crown. But power this vast comes at a cost. The same system that grants stability also breeds fragility. Every rescue creates a new dependency. Every bailout feeds the next bubble. And beneath the triumph of the modern dollar lies the same paradox that began on Threadneedle Street. The system survives only if it keeps expanding its own debt. That is the heartbeat of central banking. Expansion without end, control without accountability, and profit without production. Every system reveals its nature in crisis. For ordinary people, a crash is disaster. For the architects of credit, it is a reset, a chance to tighten control, to rewrite the rules, and to turn fear into profit. The 20th century, more than any other, proved that central banks do not merely survive crises, they are forged by them. In 1929, Wall Street fell like a burning tower. Bankers who had preached endless prosperity suddenly vanished, leaving millions jobless, homeless, and hungry. Factories closed, banks failed, families sold heirlooms for food. In the wreckage, the world learned how fragile its faith in money really was, but in that same chaos, a new order began to form. Governments, desperate to restore confidence, turned not to markets or parliaments, but to central banks. They became the emergency engines of the global economy. In the United States, Franklin Roosevelt's New Deal relied on a Federal Reserve willing to flood the system with liquidity and to break gold's grip on the dollar. In Britain, the Bank of England devalued the pound to save exports. What looked like salvation was, in truth, a transfer of power. Central banks emerged from the Great Depression, not chastened, but indispensable. When World War II erupted, they discovered an even greater utility. Wars cost more than any treasury could bear, but debt was limitless. The Fed, the Bank of England, and the new networks of European and Japanese finance created oceans of credit to sustain total war. When peace returned in 1945, the same institutions that had financed destruction now financed reconstruction. They didn't merely rebuild the world, they built a world that would forever depend on them. Out of the ashes came the Bretton Woods system, a monetary order linking every currency to the US dollar and the dollar to gold. On the surface, it promised stability. In practice, it placed the heartbeat of the planet inside the Federal Reserve. If the Fed expanded credit, the world grew. If it tightened, the world gasped. From Washington to Paris to Tokyo, prosperity was now a lever pulled by a handful of unelected men. But stability has a habit of breeding complacency. By the 1960s, America was printing more dollars than it had gold to redeem. Foreign nations noticed. Charles de Gaulle demanded repayment in bullion. Other countries followed. The vaults drained, and in 1971, President Nixon severed the last tie between money and metal. The gold standard died, and fiat currency, money created purely by decree, was born. Central banks were no longer constrained by the physical world. They could conjure liquidity from nothing, and they did. The era of perpetual credit had begun. Through the 1970s and 1980s, inflation became the public's enemy and the central bank's weapon. When prices soared, they tightened rates. When economies faltered, they eased again. Each move shifted trillions. Each correction made markets more addicted to intervention. And behind every televised speech about price stability lay the unspoken truth. The system could not function without its own manipulation. Then came 2008, the moment when the illusion almost cracked. Decades of deregulation and speculative excess had turned debt into an infinite commodity. Banks traded promises built on promises until no one remembered what anything was worth. When the mortgage bubble burst, the entire pyramid trembled. Lehman Brothers collapsed, markets froze, and fear swept the globe. In theory, this was the reckoning, a cleansing fire that should have reset the system. In practice, it became the greatest consolidation of financial power in modern history. As ordinary families lost homes and savings, central banks stepped in as saviors. The Fed slashed rates to zero and began a program called quantitative easing, a polite term for printing trillions. The European Central Bank and the Bank of Japan followed. New money flooded markets, rescuing the very institutions that caused the collapse. Stocks soared, assets inflated, and inequality exploded. For the first time, the public saw clearly. When the rich fail, they are rescued. When the poor fail, they are replaced. But in that unfairness lay a deeper revelation. Crises were not flaws, they were features. Each crash justified greater centralization. Each bailout expanded balance sheets. Each emergency gave central bankers authority no legislature would have dared grant in peacetime. By the time the dust settled, monetary policy had replaced democratic debate. Interest rates became the new legislation, liquidity injections, the new laws. We no longer asked whether the system was fair, only whether it would keep going. And that is the genius and the tragedy of modern finance. Collapse has become its business model. The worse the fall, the larger the rescue. The larger the rescue, the deeper the dependence. From 1929 to 2008, the same pattern repeats. Panic, rescue, expansion, complacency, and another panic. Each cycle transfers wealth upward and power inward, until what remains is an economy that lives only by the grace of those who control its money supply. The world calls them central bankers. History may one day call them something else. The high priests of a religion whose God is debt, whose miracles are crises, and whose gospel is stability at any cost. By the mid-20th century, money no longer belonged to nations alone. The wars had ended, but their debts had not. And out of that post-war exhaustion, a quiet consensus emerged among the world's financial elite. No country could be trusted to run its own economy without supervision. The solution wasn't another army or another empire. It was a network, A system of coordination so subtle, so insulated, that it could dictate the course of entire economies while appearing merely advisory. That network was born at Bretton Woods in 1944, when 44 nations gathered in a remote hotel in New Hampshire to design a new global order. The cameras showed speeches about cooperation and peace, but behind the scenes, the plan was pure architecture of control. The United States, with 2/3 of the world's gold, anchored the system. The dollar became the central link. Every other currency orbited it. To enforce this new structure, two institutions were created: the International Monetary Fund and the World Bank. Their stated purpose was noble: to stabilize economies, promote development, and prevent another depression. Their real power, however, came from their ability to lend, because in this new world, lending meant leverage. When a developing nation fell into crisis, the IMF would step in with assistance, a lifeline of dollars, but the strings attached were made of iron. Governments receiving aid had to adopt policies crafted in Washington and approved in Basel: privatization, austerity, deregulation. Public assets sold to private hands, currencies devalued, budgets slashed. Every loan came with a script, and that script always favored creditors. Through the 1970s and 1980s, this system expanded into what economists politely called structural adjustment, a phrase that hid the human cost. In Latin America, factories closed and unemployment soared as governments cut spending to meet IMF targets. In Africa, subsidies for food and medicine vanished overnight. In Asia, entire industries were restructured to serve export markets rather than local needs. And when nations complained, the answer was always the same: you agreed to the terms. Meanwhile, above all these institutions, another power grew, one almost no citizen had ever heard of: the Bank for International Settlements, headquartered in Basel, Switzerland. Founded in 1930 to handle reparations from World War I, the BIS quietly transformed into the central bank of central banks. Its members included the Federal Reserve, the Bank of England, the Bundesbank, and others. It was a fortress of discretion, immune from taxation, protected by diplomatic immunity, and shielded from national law. There, behind closed doors, governors met every 2 months to coordinate global monetary policy. They didn't vote, they didn't debate in public, and yet their agreements could shift the wealth of nations. Through the BIS, the financial world achieved something empires had failed to do for centuries: a unified command of money itself. Central banks that once acted independently began to move in near-perfect synchronization. When the Fed raised rates, others followed. When it printed, they printed too. Global recessions and booms were no longer local accidents. They were orchestrated rhythms of a single system. And that system grew stronger with every crisis. After the Latin American debt crisis of the 1980s came the Asian financial collapse of 1997, when currencies from Bangkok to Seoul imploded overnight. Capital fled emerging markets in waves, only to return later as foreign ownership. Whole nations were bought at a discount. The IMF prescribed austerity once again, and Western investors collected the returns. It was the same pattern as always: a crisis, a loan, a restructuring, a transfer of wealth. By the turn of the century, globalization had become the polite word for dependency. Nations competed not to escape debt, but to attract it. Stock markets replaced factories as measures of success. And behind the logos of the IMF, World Bank, and BIS stood the same quiet architecture: a world where every country's survival depended on borrowed money, denominated in a single currency controlled by a single network. Few citizens ever asked who controlled the controllers. They were told that central banking was technical, neutral, scientific, that economics was not politics. But the truth was simpler and far more unsettling. Politics had become economics. Monetary policy replaced ideology. The invisible empire of credit no longer needed kings or conquerors. It operated through spreadsheets, forecasts, and quarterly reports. By the dawn of the 21st century, the monetary empire was complete. The dollar reigned as global reserve, enforced not by soldiers, but by liquidity. The IMF managed compliance, the World Bank managed reconstruction, and the BIS managed coordination. Nations still flew their flags and held elections, but their economic fate was decided in rooms they would never enter. And yet, for all its sophistication, this empire remained fragile, because its foundation was trust, and trust is the easiest currency to lose. Every promise, every bailout, every policy assumed that the public would continue to believe that the system was stable, rational, and inevitable. But history whispers a different truth. When people lose faith in paper promises, even the most intricate empires collapse overnight. History moves in cycles, but power adapts its mask. Where emperors once stamped their faces on coins and kings carved their authority into paper, today, control hides in code. The age of digital money isn't a revolution. It's the culmination of every financial experiment before it. The same mechanisms that once debased silver, inflated paper, and securitized debt are now being rewritten in algorithms, and their promise is the oldest in history: Convenience in exchange for control. After the 2008 crisis, central banks printed trillions to keep the system alive, but they also realized something profound. For the first time in centuries, money creation could be monitored, measured, and even programmed. Cash, that last anonymous link between citizen and state, was a problem. It could escape oversight, enable dissent, and move without permission. So the architects of the global system began preparing its replacement, Central Bank Digital Currencies, or CBDCs. The idea was simple enough to sound harmless. Instead of paper cash, every citizen would have an account directly with the central bank. Transactions would be instant, efficient, traceable. Monetary policy could be enacted in real time. No more delays between printing and spending. The balance of an entire population could be adjusted with a keystroke. But behind the technical language of innovation and financial inclusion lies a far darker potential. In a CBDC world, money ceases to be a bearer instrument, something you hold, and becomes a permission slip, something you are allowed to use. Imagine a future where your digital wallet is tied to your identity, your tax record, your carbon footprint, where funds can expire to encourage spending, or freeze if you protest in the wrong street, or shrink if your risk score drops below acceptable limits. The same logic that once justified taxes and inflation now finds perfect expression in programmable money. It's not conspiracy, it's efficiency, taken to its logical conclusion. Control has become seamless, invisible, data-driven, and marketed as progress. At the same time, private digital currencies emerged as both rebellion and prophecy. When Bitcoin appeared in 2009, it was hailed as liberation from the central banks, a peer-to-peer system outside their reach. But even that revolution became a proving ground for surveillance. Every blockchain transaction is permanent, traceable, and, with enough computational power, analyzable. Governments that once feared crypto began to study it. Then they adopted its tools. What was born as financial freedom became the prototype for financial control. Meanwhile, the algorithms that manage markets now act faster than human thought. Artificial intelligence predicts interest rates, moves capital, and front-runs policy changes before politicians finish their speeches. The invisible hand of the market has become literal, automated, global, and unaccountable. The dream of self-regulating capitalism has turned into a feedback loop where machines interpret human panic as profit signals. It is the most advanced form of the same ancient pattern. Those who control information control value, and those who control value control destiny. And yet, as history reminds us, every empire of control breeds its own opposition. Just as Rome's debased denarius gave birth to barter, and the Great Depression to gold hoarding, so too will digital money create its countercurrents. Networks of trade, privacy tools, parallel economies, and communities that choose autonomy over convenience. The question isn't whether the new order will arrive. It's whether humanity will remember that money was once a tool, not a leash. The future won't collapse in a single dramatic crash. It will tighten quietly, line by line of code, until freedom becomes something you rent by subscription. And the only defense will be understanding. Because history doesn't repeat, it upgrades. The coins change, the rulers change, the empires change. But the story remains. Control the money and you control the people. What began with silver in Rome ends with silicon in your pocket. The question now is not who rules the world, it's who programs it. History loves to mark its endings. The fall of Rome, the collapse of Byzantium, the twilight of empires. But the empire that rules today has no borders, no armies, no flags. It doesn't need them. It governs through balance sheets, interest rates, and screens that glow in every hand. Its legions are financial institutions. Its provinces are nations bound by debt, and its emperors are invisible, men and women who control credit, not swords. We tell ourselves that we are free because we can spend, because we can borrow, because we can choose between cards and accounts and currencies. But freedom measured in options is not freedom at all. It is management disguised as choice. The architecture of the modern world is built not on stone or law, but on trust. And trust is the most manipulated resource on earth. From Rome's debased denarius to the Federal Reserve's digital dollars, every age tells the same story with new symbols. The faces change, the tools evolve, the language grows more sophisticated, but the structure remains. A small circle creates money from nothing, lends it at interest, and calls the result prosperity. And as long as that circle expands, the system stands. When it stops, everything it built begins to crumble. The next collapse will not look like the ones before. It will not arrive with banners or riots, but with silence. A flicker on a screen, a number that fails to load, a wallet that no longer opens. And when that day comes, most will call it an accident, a glitch, a temporary outage. But you will know better, because history has already told you how it ends. The empire that never fell still believes itself immortal. But even the strongest currencies fade, and even the most powerful algorithms cannot rewrite human nature forever. Greed, fear, and the hunger for control will always reappear, until we learn that true wealth is not what we store in vaults, but what we understand about the system itself. If this gave you a new perspective, subscribe to the channel, share it, and look deeper. Because history doesn't repeat, but if you don't understand it, it will crush you all the same. This was Ledger of Power, and the next episode begins where this one ends, with the question no empire dares to ask. What happens when money no longer needs us at all?